The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The central bank put is back and global investors are too. Live from Studio 2 here at Bloomberg headquarters in New York, I'm a seated Romaine Bostick.
And I'm a seated Alex Steele. 42 record highs now we're looking at for the S&P, 19 for the equal weighted index in case we're keeping count. VIX goes nowhere, but you know what, Romaine? We're sitting right on some moving averages for the VIX. If we go below that, do we get even more of this FOMO and this move into the equity market?
Yeah, some key technical levels right now being tested across the board to the upside and to the downside, but you put it all together and global stocks still on pace right now for a third week of gains as policymakers from Asia to the Americas continue to show that they're ready with whatever support is needed to keep their economic engines humming. New financial promises by China's Politburo, a welcome development alongside that policy easing by the ECB and the Fed. Investors worldwide feeling a sense of comfort collectively for the first time in weeks.
And now that I think the Fed's opened the floodgates, I think it opens up the door for other central banks to move faster as well.
And that potential accommodation, coupled with more evidence of economic resiliency, might actually be the secret sauce that keeps these rallies going. You had revised data today showing that the U.S. economy bounced back from the pandemic much stronger than first estimated. That's being well received with that bid to stocks, though that is coming slightly at the expense of Treasury notes and bills. There is also that added boost of, well, a reignited AI trade, though a quick reminder of the potential for that to get upended at any moment. That came today when we learned Supermicro said to be under investigation by the U.S. DOJ for its accounting practices. But that damage appears to be isolated to Supermicro for now, particularly on a day when AI also ran Micron. Rallies the most in 13 years, Alex, on an upbeat earnings forecast.
Yeah, that's definitely a superlative for you. Back to your point, though, of what's happening with yields in the equity market. This is a 30-day correlation of the two-year yield as well as the S&P. Now, when they both move in tandem, so yields go higher and equities go higher, that's the green. When they invert, that's the red part. And you can see that correlation has been picking up, which means that front end can continue to sell off and people can still wind up buying the equity market as you get stronger data. Sure, maybe the Fed might not cut as much as one may think, but it does support that underlying data, which then supports the equity market, Romaine.
All right, and that gets us to our first guest as we kick you off to the close here on this Thursday afternoon. Ellen Lee, portfolio manager at Causeway Capital Management, joining us today all the way out from beautiful Los Angeles. And Ellen, I do want to start out on what, at least for the first few months of this year, really was kind of an idiosyncratic market, a stock picker's market, if you will. There has been a lot of talk about correlations with the broader market and other asset classes. And if they do start to pick up meaningfully, tighten more meaningfully, whether that sort of takes away that idiosyncratic nature of the rally, or at least of the moves that we've seen so far.
I don't really think so. I think ultimately right now we are a little bit data dependent on if the economy has legs. And I agree with your comment that as U.S. is easing, I think, we will be able to see more economic data that confirms whether the economy is strong or not. And of course, as U.S. has started to ease, I definitely think it is giving a little bit breathing room for other markets to take action. However, what we do at Causeway here is we're looking at idiosyncratic opportunities in the equity market to find value opportunities.
Well, as you look from that, and that's the sort of the classic bottom-up style of investing, I'm sure you still have an eye on those economic conditions and more importantly on the reaction of interest rates and other things like that. Have you seen, I guess, greater opportunities emerge from the bottom up based on what we're seeing at the top level with macroeconomic conditions and the drop in interest rates?
Romaine, I think one thing we've seen is that news on China has never been more negative. And I think it's really hard to find anyone that has a positive view or sustainable positive view on China with high conviction. And hence, we are cautiously looking at opportunities in China where all the bad news is priced in. As you see here today, as the Chinese government is pulling out more tools to support their economy, any companies that have some China exposure is showing a massive rally. And this confirms that there is not a lot of negativity priced in. And hence, I think those are the opportunities from my perspective that look interesting. I'm not saying it's uniform across the board, but we see stocks like leaning, carrying that is showing a lot of weakness due to the macro risk, despite the fact that they have reasons to not be just all exposed to the China risk.
I'm glad that you brought that up. Scott Rebner over at Goldman Sachs, he was saying he's had more calls about China in the last 24 hours than he's had all year, basically, and that hedge funds are trying to reallocate. So is it the consumer side that you want that exposure to, like you mentioned, caring versus, say, the housing sector and the materials and industrial sector?
Yeah, I mean, I look at consumer, but I think it can be across the board depending on what's being priced in. But I do see opportunities in consumer because, some of the trends are secular, and it is worth pointing out a number of people going into the middle class is still strong in China. Mm-hmm. There are reasons for us to be cautious because, sentiment is weak, but there are certainly goods that, Chinese consumers will spend on. Companies like Li Ning, they make sneakers. The company trades at 11 times earnings. 1/3 of its market cap is in cash, and they sell sneakers. So I don't think that, last time I checked, that's not so cyclical. Mm-hmm. So we are looking at valuation versus defensiveness and the resilience of their business to assess what opportunities lie.
The other part of the story is actually the data here in the U.S., and we saw sort of the underlying data for GDP. Gross domestic income was revised higher over the post-COVID period. So basically, you got $800 billion more in terms of income from 2022 to 2023. If we extrapolate that and say there's a certain part of the consumer that's still doing well, how can you play that here in the U.S.?
So in the U.S., I think what I've learned acutely in the last 3 years is that, to generalize U.S. consumer is a misnomer. Depending on where you are in the income bracket, things could have been great and things could have been really bad. So I think, unfortunately, in the areas that I cover, you have to think about which type of customers you're exposed to in terms of geographies as well as income level. So for example, I also see in the middle of the country where cost of living is not so high, consumers may be doing well, even in the lower and the middle income class. Whereas in the urban areas, lower and middle income class, consumers are really struggling. So if you have exposure to that, that would be a huge struggle.
All right, Ellen, always a great conversation. We'll catch up with you again soon, I'm sure. Ellen Lee, Portfolio Manager at Causeway Capital Management, kicking us off to the close here on this Thursday afternoon. When we come back after the break, a crucial review for one of America's biggest banks that, has been constrained in just how big it can get. That asset cap on Wells Fargo, Wells Fargo has a plan to try to get out from under it. A conversation coming up in just a second.
Plus, we get a temperature check on the health of M&A and IPO environment with the head of investment and corporate banking over at Mizuho Americas.
And U.S. airports soaring to new financial heights, maybe. Airports in, the municipalities that control them selling debt to try to upgrade these terminals and keep flyers happy. That conversation and so much more coming up in a bit. This is The Close on Bloomberg.
We had the economic data that came out earlier today, right? You had durable goods better than expected. You had that revision of personal income over the 2022-2023 period also increasing. You can really see that jump within the bond market. The 2-year yield selling off. You have yields up by 5 basis points after it hit the bottom around 8:39 o'clock this morning. So what does that mean for the curve? And then where do you actually wind up investing? Bruce Richards is CEO and chairman of Marathon Asset Management. A lot to get through, Bruce, but we can't talk about the stuff unless we know what you think the curve is going and where the action's going to be.
So the curve is very important, but first on the Fed on that 50 basis point move, there's no question that they made that move, not because the economy is getting weaker. We saw 3.0 GDP today in the second quarter, and we're going to see 2.9% in the third quarter, according to GDP now by the Fed, which is Bostic and Atlanta Fed. So it's looking really strong from the economy standpoint. Corporate earnings also very strong. And so we believe
they're cutting into strength.
We believe they're cutting into strength. Thank you for saying that. And that's going to help accelerate markets, and it's risk on across the board. And so what does it mean for the yield curve? Well, I believe the yield curve, Fed funds eventually get to a 3% terminal rate, Fed funds, which puts 2-year notes around 3.25%, down from 360 right now, but the big move is not 10-year notes, which probably settle in around 4%. So they have nowhere to go. They can go lower for a trade, but they have nowhere to go over the long run. The real trade is the 6.5 trillion sitting in money market accounts that's going to see its rate fall from 5.25% to 3%. And with that decline, there's going to be a lot of money that starts to deploy that's been on the sidelines earning these higher money market rates. And so it's risk on for credit and for markets.
Does that money belong to the credit market?
That money belongs everywhere in terms of risk on. I think the number one place it goes into fixed income like securities and credit, but it also will be deployed across the board as allocators do what they do, allocate capital for what are the better opportunities. And we're seeing this globally, by the way. All the central banks around the world are cutting rates. And so while U.S. GDP next year might come in at 2% or slightly higher, I believe, global GDP 3%, which is terrific for emerging markets, terrific for risk assets like high yield and loans, private credit, equities, especially leveraged equities, where if rates come down, those equities fly. Companies that are high yield companies that have been suffering on these higher rates, that when they see lower rates, all of a sudden can generate cash flow to the bottom line. So there's all kinds of opportunities in the marketplace now.
So we'll break that down a little bit more, specifically in the private space. So if you do see that money come out and move a little bit into private credit here, I mean, what areas, where is that money going to go specifically into what areas? Because you still kind of have a lot of unresolved issues of past cycle investments here. So is it going to be a piggyback on that or something new?
I think it's all the above, because I think it's buy all credit generally as a big theme, and within private credit, there's what you're talking about is the opportunity.
But you think investors are going to do more of a basket?
So I think there's going to more of a basket. I think there's going to be opportunistic credit because of all those LBO deals at zero rates that still need to work out, and there's going to be tremendous opportunity there. And in fact, if you can buy into a book of existing, assets, from that vintage, that's probably going to be a really good deal. Okay. So number one. Number two is direct lending. With rates coming down, and you know this, the LBO machine is going to start up big because earnings are strong, the economy is strong, and now you're putting in the formula lower interest rates, which we're going to see an enormous boon in leveraged buyouts. We're financing some of that in the direct lending market, and our brethren out there will as well. And then finally, asset-based lending is a big business that's getting bigger, and there's no stopping that train because it's already left the station, and we're going to see more and more of those deals. There's not a week that doesn't go by that we're not doing 3 transactions of private credit in our asset-based lending business.
What's actually driving some of this activity? And we're going to speak a little bit later here with a real giant in the M&A space. And I'm curious, is this sort of being opened up by the drop in interest rates, or is this more about the read on the economy and the idea that those worst-case scenarios that everybody had priced in last year never really came to be?
I think it's both. And I think it's corporate earnings are strong, the economy's doing well, and now you're applying a lower interest rate to finance that buyout. Remember, for every dollar or $1 billion that gets spent on a buyout, $500 million is financed with debt, and that cost of that debt is a lower level, which means it helps accelerate transaction flow. So we're super bullish. Our direct lending team never been busier. It's in the pipeline today. Its deals closed recently, but what's coming is prolific.
You mentioned EM debt. Does that include China?
That includes China. China is.
You like China EM? You like China debt?
So it's a fixed allocation for us as opposed to an overweight or an underweight. And as it relates to China, and there's been a lot of news about how the equities have flown, and K-Web's up, and Alibaba, and all the big tech companies are up. But the other side is, because it's a tale of two cities, are the banks are deficient. They don't have capital. It's being improperly marked, their loan book, because the real estate market has collapsed. These real estate projects, both commercial and residential, are so far underwater, there's very little to resolve on many of these loans. And so the whole construction cycle of building buildings and building roads has come to an end. And so even the steel mills are going to file for bankruptcy. So while the tech sector is going to come out of this with low multiples and good valuations, and everyone's missing out on this because there's very little capital allocated to it. The other side of the equation is, China is in a very tough position because of geopolitics, because of increased tariffs, despite who's going to be in the White House, coming their way. And so I wouldn't want to be long China. I would want to be long some of the undervalued tech if you're going to go long China. But it's not our trade. We don't invest in Chinese tech. But as it relates to sovereigns, the sovereigns are fine credit.
Yeah.
It's the second biggest economy in the world, and it has no problem servicing its debt. And with interest rates coming down, it's bullish for its debt.
We literally only have 30 seconds left, so I hate to throw this at you, but I'm gonna. We had a piece out on the Bloomberg that talked about Citi and Apollo joining forces to work together on like $25 billion worth of deals over the next 5 years. Are you talking to big banks about working on stuff?
So first of all, I love that transaction for Apollo. I think it's great. So they have a theme. They'll be able to feed a theme both on the investment grade side as well as the high yield side and broadly syndicated loans. But those are great partnerships. What I love is like the Marathon Webster Bank partnership, where we're in the middle market space with a commercial bank that has a strong direct lending sponsor coverage team, and we are exclusive partners. And it's a powerful partnership where for our clients, we have the flow of all the private equity sponsor middle market loans, strong covenants, strong financial documents, low leverage ratios that are coming into our book. As a result of that relationship. So the banks and the asset managers, I'm a huge fan of that. I think it works for Apollo when you're talking about upmarket.
Yeah.
I think it works for Marathon when you're talking about the value in the middle markets.
All right, Bruce, got to leave it there. Always a great conversation. Bruce Richards, CEO and Chairman at Marathon Asset Management. Stick with us when we come back. A closer look here at that report on Wells Fargo and the potential maybe to finally get from out underneath that Fed asset cap. That's coming up next. This is Bloomberg. All right, let's get a view from the sell side with our top calls. The big movers on the back of analyst recommendations, and we start off today with New York Community Bancorp. Barclays upgrading to overweight on a more favorable risk reward for the regional lender. Analyst Jared Shaw saying that the company has completed the heavy lifting around credit evaluation and restructuring its balance sheet, although he still has some caution about the challenges ahead. Investors, though, not showing any caution today, bidding the shares up by about 7%. Next up, let's take a look at Sonos. A double downgrade today to underweight over at Morgan Stanley. Morgan Stanley not impressed by that app redesign that has already seen heavy backlash from existing users who make up some 44% of annual new product registrations. The analyst saying that the app design misstep coupled with weak demand will turn the volume down on both the top and bottom lines. The shares moving lower by 4% on the day. And finally, Nordstrom. The shares being taken down a notch to sector weight from overweight over at Key Bank. Worries here about that proposed deal to take the department store private. While the analyst still has a favorable view of Nordstrom's strategic priorities, says the uncertainty around going private will continue to weigh on the stock price. The shares down 1.4%, and those are some of our top calls. Let's pivot now and take a look at one of the big movers on the day, and that is Wells Fargo, up about 5% here after Bloomberg reported that the bank has submitted a third-party review to the Federal Reserve to escape a regulatory sanction imposed back when Janet Yellen was chair. That asset cap, which has been a big burden on the company, limits the bank's size to about $1.95 trillion of assets. Gerard Cassidy joining us right now. He's head of U.S. Bank Equity Strategy over at RBC Capital. He's got a sector perform rating on the stock. Gerard, let's just start off here. Whether we're actually finally seeing the light at the end of this tunnel on what has been, 7-8 year saga now for this bank, an asset cap that has severely limited what this company can do and how much profits it can make.
It certainly has. And as you pointed out, it was the last act by Janet Yellen when she was Federal Reserve chairwoman back in 2018. It was February 2018 when the cease and desist and the asset cap went into place. And under that, since that time, management led by Charlie Scharf has worked very diligently in doing everything that the Fed has required. And this third-party review of the systems was part of that initial requirement. And this could be the final, piece of the puzzle so that they finally do get released from the asset cap. I think management would point out that they're probably not going to get released from the asset cap this year. This is probably a 2025 event.
And we should point out, of course, Bloomberg is citing people familiar with the situation. We did reach out to Wells Fargo for comment. They declined, as you would expect. I am curious, though, Gerard, if you want to play hypotheticals here, if we do get to a point where that asset cap is lifted, what does Wells Fargo become? Is it going to be a meaningful change to how this company does business?
Over the longer term, it will certainly have obviously a positive effect. But we shouldn't expect, once the asset cap is lifted, that they're going to go out and try to grow this bank by 15 or 20% in size over a relatively short period of time. They're going to do it very methodically. They're building out their capital markets business quite effectively. And now, once the asset cap is lifted, obviously, they could take in more deposits. Even though this is called an asset cap, it's really a deposit cap, because you can sell off your assets, your loan originations, and package them into asset-backed securities. So they've had to manage their deposit base more efficiently and more effectively. And if there's a sliver of a silver lining, is that the deposit makeup for this company is stronger today than before the asset cap.
That's such a good distinction. Gerard, is there a timing to all of this? And I realize it's not going to be like a magic switch, but is there one or two things that you can do that they can increase transparency, that the market can say, all right, they're on their way?
Alex, it's pretty tough, because when the banks deal with their regulators, they're very tight-lipped about what they can say. And management here obviously understands that and has adhered to that. So it's tough for us outsiders to read the tea leaves. But one indication that I think is very significant is that the controller of the currency, they also slapped a cease and desist order on the bank for the same issues that the Fed did, which was the consumer issues of 2016. And that cease and desist order was lifted in the spring of this year. So if there's a sign, and the stock reacted obviously favorably to that, if there's a sign that the Fed is going to move, I mean, that is a precursor to it. So we would expect, again, probably sometime in 25, that this asset cap finally will be lifted. It will allow Wells to then obviously grow faster than they've been able to grow in the past 5 years.
All right, Gerard, great to see you. I'm sure we'll see you a lot in 2 weeks around bank earnings. Gerard Cassidy at RBC Capital Markets.
2 weeks?
Yeah,
wow,
man,
is it
2 weeks.
that right around the corner?
Oh, yeah. Nonstop banking. Hamster wheel.
Hamster wheel. But it gets to the point, too. I mean, and obviously this is going to be potentially a big deal for Wells Fargo. But I thought it was interesting what he said. How much discipline are we going to see by management to make sure they just don't go, get drunk and go whole hog?
It does feel like with all the drama, though, that's continuing to unfold versus practices from years and years ago, that they'd have to be definitely on that as well. And how much that would be worth to the stock at the end of the day? Stock up by 5%. All right, coming up, Michal Katz is head of Mizuho's investment and corporate banking business in the Americas. We're going to talk M&A and the trends that she's seeing in the financial sector. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to The Close. I'm Romaine Bostick.
And I'm Alex Steele. I was interested in watching Jeffrey's stock today. Jeffrey's, yeah, because I feel like they shine the light on what we can expect from big banks.
You think so? I saw them. Look, you're starting to see a little bit more of a rebound in some of that deal-making activity. Obviously, Jeffrey's giving us a little sense of maybe what we're going to hear when we get the other big banks start out the new earnings cycle. And like what I'm told is, Alex, 2 weeks' time.
2 weeks' time. It's the hamster wheel that will start. But yes, M&A pickup, that's what it looks like.
And of course, this has been a big topic of conversation given the rally that we've seen in public equity markets. And of course, that drop in interest rates, that easing cycle that is now just starting. Remember, we came into 2024 with expectations for this to be the year of M&A rebounds. But so far, transactions volumes this year have been, well, a little bit less than expectations. North American deal volumes has fallen again this year from the 2021 highs, but that's due to a large range of factors like strict regulatory oversight and unfavorable macro conditions. So what does 2025 have in store for deal making? Well, let's talk to one of the stars in that space. Joining us right here in Studio 2 is Michal Katz. She's head of investment and corporate banking at Mizuho Americas. Michal, great to have you here on the program.
Thanks for having me.
Let's talk a little bit about kind of where we are right now in this cycle in 2024. I know things didn't quite live up to expectations at the start, but just over the last few weeks in anticipation of rates coming down, the Fed starting that easing cycle, a lot of people were saying this is kind of the opening that investors wanted to see, and for that matter, boardrooms, corporate boardrooms wanted to see as well.
Right. And we have begun to see this increased rebound in activity. There's been much talked about the mega deals that have been in the market. So the 1.1 trillion of volume that we've seen in the U.S. M&A markets, 30% or so of that has been in mega deals. But we have begun to see this increased participation from private equity, which have pretty much been sitting on the sidelines during that rate hike environment that you've been talking about. And so Mizuho had the opportunity to participate in a majority of those largest LBOs that have come to market, whether it was the CDNR $15 billion Truist Insurance LBO, or their Instructure, or recent one that was announced is, Squarespace had been announced, and Smartsheets. And so the interest rate pivot is going to be a catalyst to see more activity. Also, the capital markets have been pretty much open, wide open. Credit spreads are tight, great investor appetite, and so it does have the makings of a constructive environment to induce that confidence that you need for M&A.
What about the other element of deal making, another big element of that, which is the IPO market, which has been somewhat dormant? There's been this idea that there's so much going on right now in the private space. All of these companies that are fairly large, investors who are looking for some sort of exit path. Are we going to see more IPOs?
I hope so. And when you do take a look at the equities volumes, they are up, but the comeback is not back to the pre-pandemic norm, so to speak. And the big challenge has really been tech, which historically constituted 30% of the IPO market, a sector that's been very much impacted by the rising rate environment. So think about it on an average year. Putting aside the 2021 high water mark that you just talked about before, you'd see 40 or so tech IPOs. This year, we're clocking 9 tech IPOs. But the market is there. The VIX is sitting at levels that are, again, conducive for that. Stock markets, I don't know where it is just this moment.
Record high.
Record
highs.
How many records, Alex?
42.
42 this year.
There you go. And so when you take a look at how corporates have been performing, how earnings have been doing, the economy being resilient and kind of heading into that soft landing, so to speak, should be conducive for more IPOs.
What do we need to see to really spur any of this? Do we get past the election, or is it a multitude of, say, rate cuts from the Fed?
I do think that the market does not need perfection, but it does need some clarity and some visibility and some certainty. And we began to see that with rates. You've had the pivot begin to start. So from my seat, I don't think it's necessarily whether it's 3, 4, 5 cuts, 25, 50, but the pivot has begun. And I will tell you that when you think through the sentiment of the boardroom right now, is that for the last couple of years, you've had folks looking internally at their operations, very much focusing on organic growth. And I do think that there's greater confidence and probably greater sense of urgency to look at M&A, to look at other avenues for growth. And I would say there's both a defensive and an offensive element to it. There's that FOMO, fear of missing out. But the offensive part to it is, do you want to future-proof your company and position the company to partake in some of those next-gen trends? And many of those will be through M&A. And candidly, that's the reason Mizuho did our own M&A by acquiring Greenhill. We had anticipated this return in the market. We wanted to broaden our M&A capabilities and add headcount.
Well, talk a little bit more about that. I mean, you've been in this role. I mean, you joined kind of right before the pandemic at Mizuho. You've done a lot of hiring already. Obviously, there's the Greenhill acquisition. You've taken Mizuho in terms of investment banking from something we didn't think about much here, at least in the U.S., and now turned this into when we see the league tables at this end of this year, you're going to be pretty high up there. And I'm curious as to what more it's going to take in terms of hiring to continue doing what you're doing.
So we've added 370 bankers through the Greenhill acquisition, and we continue to add selectively across areas where we think that there's going to be an opportunity. Infrastructure is one of them. We've hired 2 bankers, one in Australia, one on the West Coast. Healthcare is another area where we've been selectively adding talent. But remain, after putting that 2 organizations together and working through it, it's a year of integration and execution for us. And so more to come.
Is there a lot of competition, though, for that new talent? I mean, we were talking a little bit earlier. There's, this story about, Apollo and Citi actually working together, and we're seeing kind of a little bit more of a collaboration between the big banks and sort of the private capital firms. Is that also in your universe?
I think that the lines have been blurring across across financial, non-financial organizations. So you asked about the war for talent. I think that there's always competition for good talent. I would tell you this is not the 2021 hiring mania and silent resignation, which has brought about this competition. But I would say that this is a highly lucrative and competitive industry, and getting good talent is something that we think about all the time, and maintaining talent and training talent.
Is your biggest enemy right now in the M&A market at the FTC and like the DOJ?
It's a great question. So much has been talked about the regulatory environment and its implication. If you listen to an interview that Lena Khan did, I think it was a year or so ago, basically saying that most transactions that would be subject to HSR review do not get a second review, and the fact that they've had a mixed win-loss ratio. I will tell you that a couple of factors going. Many buyers and sellers just don't have the ability or the willingness or the appetite for a prolonged process. On the other hand, we've been living in that environment for quite some time. And it was really interesting to see this rumored big tech approach. Obviously, no validation of it, but the Qualcomm rumor, that's a big potential transaction in a sector that's been at the crosshair of not just the regulators, but the administration. So I would say when there is a transaction that makes sense, where there's industrial logic, and there is the patience to do so, you'll see transactions.
But when you see those types of transactions, or at least the rumors of those types of transactions, I mean, and let's just say hypothetically, somebody gives you a call and says, look, we want to do this deal. What's the first thing they're asking you? Are they asking you about the regulatory environment first, or are they asking you more about the financial costs and how investors are going to be pleased or not pleased?
The first thing they ask me or we talk about is the industrial logic. What does 1 + 1 equal? Because I think that is really ultimate, it has to be foundational. Then you're talking about the more tactical aspects, which is how are you going to finance it? Is it going to be stock cash consideration? If it is going to be in cash, you need to raise debt. In which markets? And then, of course, you have to start preparing for the regulatory aspect early on. You got to think about remedial opportunities to the extent you will get a second review, to the extent that it will be contested.
All right, Michal, we have to leave it there. Great conversation. Really appreciate you taking time for us. Michal Katz there, who leads, of course, the M&A team over there at Mizuho Americas. Coming up here, we're going to take a closer look at Super Microcomputer, a massive drop in the shares today on the back of news of a DOJ investigation. That's coming up next here on The Close on Bloomberg.
One stock to follow here. Super Microcomputer shares are down a whopping 12% after this Wall Street Journal reported that the DOJ is probing the server maker over possible accounting violations. Remember, last month, Hindenburg Research published a report on its own on the allegations from a former employee. Bloomberg's Abigail Doolittle joins us now. Kind of a tremendous move, right? From small caps to the S&P, and then now this.
It's amazing, actually, because not so long ago it was an $8 stock. Then it was a $1,200 stock, greater than $1,200 stock. It was added to the S&P 500. Now it's a $400 stock. So all over the map. Now, relative to this DOJ probe, the Wall Street Journal is reporting on it. It's related to the Hindenburg whistleblower, as you mentioned. So if we go back to August, Hindenburg put out a short report on August 27th. Now, it's interesting. The stock actually traded down right before that report was released. And then 2 days later, the company delays their filing. One of my sources says that it was already known that filing was going to be delayed. The company already knew that. So it seems almost as Hindenburg somehow had inside sources on that and then piggybacked off of it. Relative to this probe, it's the same whistleblower that Hindenburg names for essentially, let's just boil it down to cooking the books. Essentially.
Yeah. But the bigger issue here is just seemed to be a drawn out thing now. Like this wasn't, at first this was just allegations, maybe it goes away, but now you have to, I mean, if you believe what the Journal reports, that now you have the DOJ involved. I mean, this isn't something that just gets settled like overnight.
Yes, well, that you're exactly right. And the bigger risk for investors is what else might they find? You know, I was speaking to Woo Jin Ho, our Bloomberg intelligence analyst. He is saying on the record that he does not think that there's any financial malfeasance here. However, it was a very small company, and there could be some weak financial controls. In fact, that happened back in 2015, where they delayed a filing at that time, too. So they basically, Alex is talking about it going from a very small company to a large company, all this growth. It was almost like they couldn't incorporate it quickly enough. And yes, you're going up against the DOJ. For the DOJ, this could be a trophy case. AI, this big name all of a sudden, and who knows what they will find. It could be problematic.
Yeah, and then to that point, when you move from being a small cap into the S&P, you're going to have more analyst coverage. Yes. You're going to have more scrutiny.
So much
it's
more
a different
scrutiny.
type of scrutiny than it would be for a small cap company,
Absolutely.
and that has the issue there.
Well, and now because you're absolutely right. It just creates all these issues. Plus, there's negative press for customers. I mean, there's not a lot of other people creating these AI servers, so from that standpoint, they're probably a little bit more.
And that's why Nvidia was down.
Yeah, the sympathy effect. Yeah, that's a great point.
Well, and to your point on analyst coverage, I was looking at 2 years ago. There were 4 analysts covering this company. A year ago, there were 9. Today, there's like 18, 19. So, like you said, it's just a light has now been shined on this company. So you better make sure everything's copacetic.
That the light all works.
Yeah.
Something like that. All right, Abigail, thanks a lot. Abigail Doolittle joining us there. There's some metaphor that I
love that. Mixed metaphors.
Yeah, why not? Okay, we're about 15 minutes from the close of trading. We're looking at 42 record highs potentially for the S&P, 19 for the S&P Equal Weighted Index. Jason Pride, Chief of Investment Strategy and Research over at Glenmede, will join us as we head into the closing bell on this day. More Chinese stimulus, more heavy volume. S&P up about 0.3%. This is the close on Bloomberg.
I look at consumer, but I think it can be across the board depending on what's being priced in. But I do see opportunities in consumer because, some of the trends are secular, and it is worth pointing out a number of people going into the middle class is still strong in China. There are reasons for us to be cautious because, sentiment is weak, but there are certainly goods that, Chinese consumers will spend on.
Ellen Lee over at Causeway Capital talking about the secular nature to some of this rally, setting up for what's going to be the 42nd record high of the year for the S&P 500.
And for the S&P Equal Weighted, the 19th, just in case we're keeping score. So
I'm glad someone is.
So we're still a tech game, to be honest. But it's interesting, if we take a look, just talking about China, look at the divergence here. You have the S&P materials sector leading the S&P, yet energy is down by over 2%. If it was just a China story, you would think those two would move together.
Yeah, I don't know. How much of that, though, is because of, all this disruption or lack of disruption they're saying within Libya or some of that, or is that drop, I'm talking about the drop in energy, or is that drop in oil that we're seeing, is that more about maybe people not buying that the world's second largest economy is out of its doldrums?
Maybe. I think it's more that there may be an agreement in Libya that will bring more oil on. Also, it feels like the Saudis are getting tough with Iraq as well and saying, look, you guys got to comply. If not, we're going to dump a little bit more oil on the market. So that could be weighing on it. But nevertheless, you take a look at the other cyclical trades like materials, that clearly feels like a China story now.
Yeah, interesting complexion to the S&P right now. Energy, real estate, utilities, those are your big laggards on the day. Materials, tech, financials, the top 3 performing sectors. What does that mean? Well, let's pose that question to our next guest, Jason Pride, Chief of Investment Strategy and Research at Glenmede, joining us now to help us count down to those closing bells, which are just about 8 minutes to go. And Jason, I am curious as to what people think they are buying right now in this rally. Is this really that sort of secular story? Is it that story about the cyclical rebound? What exactly are people embracing here?
Romaine, and first, thanks for having me on. I think it's a little bit easier than that. I think this is a story of an ongoing economic expansion, a decent earnings cycle, valuations for the market, particularly when you look down the capitalization spectrum, actually being reasonable the smaller the capitalization names that you get to. And let's just put it on the table. Behind all this is a Fed rate cut cycle that has begun. 50 basis points on the table, likely 75 to 100 basis points to come throughout the year, another 100 plus perhaps a little bit more next year, going to a long-term neutral rate of somewhere around 3% within that scope of that pattern. I think that's what's sitting in the background.
I am curious, though. I mean, for those investors who stayed invested in this market through all the ups and downs, they're making out pretty well. As you know, there are a lot of people on the sidelines. We just had another headline saying money market funds continue to hit fresh record highs in the latest week here. Assuming that money does start to come out of some of those areas here, is it too late to chase this rally?
I think you're going to be careful on the chasing the rally. So if a client's portfolios are under-positioned relative to long-term policy, yes, you should probably continue to nibble at that to get those back towards policy at this point in time. However, we're actually seeing a lot of clients' portfolios are actually overweight equities because of the rally that we've seen. We find that we have to continually kind of chip away at that and rebalance. So we really are advocates of the idea of figure out what your policy is long-term, get on that target based on the way the market is right now. And then perhaps the second piece of that is diversify. Don't allow your portfolio to get overly concentrated in those single topic names that we all know about. Diversify the portfolio and round it out.
We have 2 weeks to get to earnings before bank earnings kick off. In the meantime, what are going to be some of the catalysts in the market?
I think we've got a couple of things next week that are going to be really front and center, right? We're just talking about rate cuts. We'll center to what's going to drive the Fed's decision on whether they go 50 or 25 basis points at the next meeting will be the employment market. The interesting thing is, jobs report, very noisy statistic that could come out either way, but it influences their behavior anyway. We think investors really need to round out their picture of the employment market. If it comes in a little bit stronger, they're probably going to be doing 25. If it comes in a little bit on the weaker side, they'll probably be doing 50. So that impacts the rate decision. The other thing is, look, there's this looming port strike that could impact 40% of our inbound shipping traffic that we just need to keep our eyes on in the background.
Totally agree. We'll get to that just in a second as well. So then to the jobs number, though, and the market reaction function, mid caps also at one point hit another record high today. We're not on that record right now, but nonetheless, the Russell, though, has not met that record from a few years ago. Do you need to be playing those spaces as we look towards jobs numbers and as we look to the Fed?
Absolutely, Alex. We actually think down the cap spectrum towards mid cap and small cap is actually where you need to have an overweight in your portfolio at this point in time. Those issues trade closer to fair value. You have had a headwind for the last 2 years plus from rising rates. That headwind is now a tailwind because those companies, they have floating rate debt. They're more exposed to debt. That becomes a tailwind to them at a time where the economy is actually doing reasonably well. That's going to be a combination story that's better for investors than probably what we see at the larger end of the spectrum of capitalization.
How much faith can you put in that, though, Jason? For every sort of, bright economic data point we've gotten over the last few weeks and months, it always seems to be accompanied maybe a day or two later by another data point that seems to suggest the consumers may be weak or the labor market softening here. What's the balance right now?
And I do think you have to have a little bit of balance in your thought process on that. One of the main reasons is we are still in the late stage of this economic expansion. We never saw a recession. We are not back to early stage. We're not back to even like the mid cycle of the economy. We're still at late stage. Late stage does have some residual recession risk sitting out there, probably in that 25 to 35% range, but not 50% plus at this point in time. So you do need to be careful not to take the equity positioning too high.
Yeah.
But within that, every once in a while, the market gives you this weird opportunity where there's dislocation within equities. We think that's what's setting up within large versus small.
Final question, and this is also on the economic front. This idea, as you just mentioned a little bit earlier, a potential strike in major East Coast ports that could start next week. Should investors start to prepare for meaningful disruptions in the same way that we saw during the pandemic that not only disrupted what we bought, but of course the cost of those goods?
I think people need to be aware of it. It could cause some disruption. It could cause some volatility. 3 channels of potential causes. If we have port disruptions, 40% of the traffic can actually have an impact on economic activity. It can have an impact through inflation channels. And let's add the additional factor to it. This is an election cycle that we're going through. The volume of noise around a port disruption would probably be bigger right now than previously. Having said that, it's more likely than not we'll have negotiations kind of make this an easier transition. We'll find resolution to it. We're probably of the mind that it is probably not the magnitude of disruption.
All right, Jason, we have to leave it there. Always a great conversation. Jason Pride over at Glenmede helping us count you down to those closing bells, coverage of which starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic with Alex Steele taking you through the closing bell, a global simulcast. It starts right now. Scarlett Fu joining us in the TV studio. Carol Masser in the radio booth. Stephen Carroll in for Tim Stenovic today as we welcome our audiences across all of our Bloomberg platforms.
I only work now with people who have Carol in their name. I'm just going to tell Tim that.
Welcome to Carol and Carol.
Have Carol in their name.
It's very confusing here. I don't know which Carol we're going to right now. Do we start with Carol or the other Carol?
We're both really good. I'm just going to put it out there. Having said that,
he's got more letters in his name, so I think that means he's better.
He does. Yeah. All right, so Stephen Carroll, you take it away.
Okay, look, I'm excited because we might get that 40-second record high close for the S&P 500. I feel like this is just as an occasion, three of them in a week. It's just for me. That's why.
It's just for you, absolutely. Having said that, it feels a little bit of a tortured trade today. I mean, we do have most names in the S&P 500 today.
Tortured.
Higher. Well, you know what I mean? Like, it's not really clearly defined. I feel like we're watching the economic news. We got the upbeat Micron news. I don't know. I just don't feel like there's totally a clear way forward in today's trade.
Well, we're all distracted by what's happening in New York. At least those of us who are in New York City.
What's happening in New York?
A certain mayor being indicted.
I spent 2 hours on radio doing this. Must we?
Really?
Must we do this again?
I'm sorry.
I'm still traumatized.
Someone's been indicted? Raise your hand if you've been indicted. I don't know. What's happening?
I have not been indicted.
Too soon?
Just way too soon.
Stop looking at me like that.
Too soon.
But you were talking about what the catalyst is, guys. I really do feel like China's still behind some of this. I was saying this earlier.
Too, yeah.
You look at S&P Materials, and they're leading the way.
It's really like you looked at my gainers. I love you.
Yeah, I have to agree with you. And I mean, I know there's people are going to parse this and say, look, this might not be enough stimulus, but just the general sentiment shift here, I think certainly has a big psychological effect here. You get the clapping and the cheering here in New York with those closing bells here. Another record high for the S&P 500, up about 23 points, right around that 57.45 mark, 0.4% gain on the day. The Dow also higher by more than 200 points, of 0.6%. A similar percentage gain for the NASDAQ Composite. And let's take a look at the Russell 2000, getting in on the action as well, up about 12 points. Or 0.6%.
All right, guys, let's take a look at the S&P 500. As I mentioned, most names in the index higher today, about 331 names gaining ground on this Thursday, 172, Scarlett, to the downside.
Yeah, let's take a look at the 11 sectors in the S&P 500. And Alex mentioned those materials companies on the China story, the China stimulus story. Materials up almost 2% as a group. Tech not far behind, gaining 0.9%. And Wells Fargo lifting the financials to a 0.5% gain. On the downside, you have energy stocks losing 2% as oil prices decline. WTI now at below $70 a barrel. REITs also lower by 1%, and utilities losing 0.75%.
All right, so a lot of green on that map. Let's get to some of the individual gainers. The number one gainer in both the S&P 500 and the NASDAQ 100 is Micron Technology, finishing the day off its highs, but still almost a 15% gain. It's the largest U.S. maker, as you know, of computer memory chips. It did gain the most in nearly 13 years, gave a strong sales and profit forecast, helped by strong demand for AI gear, artificial intelligence gear. Analysts also coming out very positive about the AI demand and the company's pricing strength. So no doubt about it, a strong performer. Alex mentioned every day it feels like among the most read stories is what's coming out of China and their stimulus moves. So the NASDAQ Golden Dragon China.
There it is. I was wondering if you're going to mention it. You used to mention this all the time. It has its best day in years, and you don't even start with it, Carol.
Well,
I don't know you anymore.
I don't know. Well, I had to go to Micron. But anyway, it is up about almost 11% in today's session. It is a favorite. If you look at the NASDAQ 100, PDD is one of the outperformers in today's session. So again, officials pledging to make real estate market stop declining, their strongest value yet to stabilize, that crucial sector in the Chinese economy that we know has had such a tough time coming out of its malaise. So that is definitely some outperformance today. And then one of the airlines, I wanted to mention Southwest Airlines, guys, up about 5.5%, was up as much as 11% in today's session, authorizing a new $2.5 billion stock buyback program, and also detailed some plans to revamp customer-facing policies. This company and this carrier trying to fend off some activist moves, and so nonetheless, investors liked what it had to say. What?
Did you see some of the moves in the other airlines, though? You had United up 8%, JetBlue up 8%. I mean, was this all Just what? Just on a sentiment
Well,
shift
the
or
whole
something?
airline index is up over 6%. Best day since October 2022.
I'm not sure why. Do you guys know? Is it just because of
bag fees?
I don't know. I don't know. It's not.
China?
No.
Southwest Airlines should be lower
Hey, Carol, you're from overseas. What's going on?
Yeah. People are getting on planes. That was
What was that?
Sure, let's go with that. Okay, look, I'm gonna get us back on track. I'm gonna try. We went from Micron higher, Supermicro ditched the end, and we've got Supermicro shares slumping after that Wall Street Journal report that the U.S. Justice Department investigating the company. This after a Hindenburg Research report last month talking about glaring accounting red flags at the IT firm. Representatives of the company and the Justice Department haven't responded to requests for comment. The shares down 12% at the close. We've got Sonos shares also falling after Morgan Stanley double downgraded the stock from to underweight from overweight. It doesn't sound good. Their note saying that the speaker company's app redesign, which brought huge backlash from customers, if you want to find it on social media, lots of people talking about it, impacting the top and bottom line there as well. Our opinion columnist Dave Lee was writing about this just a couple of days ago on the technical debt that the company is facing, and it's one of those issues that can come up when you're dealing in tech like this. Sonos shares down now about 30% on the year. And I'm indulging myself by talking about chocolate because Hershey's shares are down ever so slightly, so just about counts. Jeffrey's downgrading the chocolate maker to underperform from hold. They're turning more cautious because customers apparently are pulling back on spending on chocolate because of the increased prices, which we've been talking about, but switching to other snacks.
Hershey's?
Yeah, cocoa, man. It's like a record high yet again.
It's not even good chocolate, Hershey's.
Oh, how dare you. How dare you. Apologize to America.
But Romaine also hates chocolate. So
No,
I think
we were camping this past weekend and we were making s'mores. So I went through my I don't know, we had like a stack of Hershey bars.
How much did it cost you?
Well,
were you making s'mores?
There we go.
Did you say you were making s'mores?
yes, we were on a campfire. We were camping. I don't know. Does that bother you, Carol?
I don't know. I'm just trying to get my head around that picture.
I know.
So-
Romaine at a camping site.
Right?
Yeah.
And next to a campfire.
Don't worry.
Was it more like
I tossed my
glamping?
tie back over, and
some
it was all
glamping.
good.
There was still a bathroom in the cabin. Let's not think we're like
it was
it's
rustic.
glamping.
It was
I mean,
rustic.
It was glamping.
I mean, it's a middle between regular and glamping. But okay, can I go to yields now? I'm going to yields.
Sure.
Because this is where some of the action was too. You're looking at the front end here. We're up by 5 basis points. The back end, a touch of buying. And guys, this really was about the data that we saw earlier today. Durable goods orders better than expected, and you had that gross domestic income revision over the post-COVID period where you had nearly $800 billion added to between 2022 and 2023. That was something.
Yeah, we're actually getting some earnings out, believe it or not. It never stops. Vail Resorts, ticker MTM, shares down 5%. The company coming out with their fiscal fourth quarter numbers. Skier visits down significantly here, 699,000. The street was looking for 829,000. Now, of course, we are still off season, but that does not necessarily bode well. Revenue, though, came in relatively in line with estimates at around $265 million, but the company's still posting a loss per share of $4.67. That's higher, or a deeper loss, I should say, than what the street had priced in.
All right, something we're certainly keeping an eye on. That stock down about 5% in the aftermarket. Hey, the other thing we're keeping an eye on is what's going on at Starbucks. Scaling back on the Italian pastry brand beloved by longtime leader Howard Schultz. Princi?
Princi.
Oh, go ahead.
There you go.
Take it over, Stephen.
Look, I scramble past this because there's one in Soho in London that I visit regularly. It's a very impressive spread, but they're one of those brands that got into Starbucks and were able to use their own brand under the Starbucks roasteries in particular, but they're moving on from them now. So they say they're going to be replacing it with great products.
Are you upset that they're losing it?
I mean, I can still get it, so I'm okay.
Oh, you're fine.
But I'm worried for other people.
Okay.
You know, they are going to keep this brand, though, in certain of their roasteries, including in Milan and in its stores in Tokyo. And by the way, I was in Italy, and there's a huge long line in front of the Starbucks roastery.
I was like, please don't tell me that you went to Starbucks.
No. But I was kind of bewildered why there are people waiting in line at Starbucks in Italy.
Stephen's gone there.
They had air conditioning in Milan in the
where do you go
summer.
to Paris? You see all the hordes lined up outside of McDonald's or Taco Bell.
That really hurts. I'm actually bummed about this because my daughter loves those croissants.
There you go.
All right.
You know, the other thing that I noticed when I was in Milan, because it was Fashion Week, is that there are a lot of people wearing these wide-legged pants, and that's a new thing. These wide-leg jeans, they might not be that much money. It might cost like $100, but the problem is you then have to buy new tops to pair with the wide-legged pants.
This is okay.
Because a crop top
Crop top.
Really,
did these people not own tops before?
No.
Too
Okay,
big and
wait.
big. You just look like you're dressed like a baby.
You got to understand, when skinny jeans were in, you had to have oversized tops. And now that you have wide-legged pants, you need a smaller top on top to kind of balance it out.
I refuse.
Are you wearing wide-legged pants now?
I am.
She's not wearing a crop top. Let's just be clear.
Well, thank you.
Don't wear crop tops.
All right.
No.
There you are. By the way, I just want to say I like this new Carol. Do we?
No, he's gone tomorrow.
Can we just swap?
Radio in London every morning.
Yeah, you can stay. We got a Starbucks roastery here, or whatever you want, in our own Soho or whatever it is down here.
I think we have room for one more box here,
Oh,
so
stop
you
it.
can stay. You can stay.
Yes, that's just what the show needs. Another anchor.
We got to wrap. All right, Alex is heading out. She's going to not buy these wide-leg jeans.
I own them already. That's why.
All right.
She invested in them a couple of years ago.
Of course she did. All right, Scarlett and Romaine.
Style icon. That's right.
Continuing
I know
on
that's why I like this guy.
television, and the good Carol and I are going to continue on Bloomberg Radio, guys. We will see you again, same time, same place tomorrow.
All right, and our coverage continues here on Bloomberg Television. A refocus on the economy with the first look at the PCE data since the Fed cut rates. That data out tomorrow. We give you a preview of it today. That's coming up after the break. This is Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. Another record high for U.S. markets. The S&P continuing to inch ever so higher, but a big part of that was what we saw overnight coming out of Asia. Another big rally in Chinese stocks. You saw that in the CSI 300. You see that reflected in the MSCI Asia Pacific Index. The MSCI All World Index also hitting a record high today. Though we did see some stress in the markets today, particularly in the energy space. Energy stocks as a group down about 2% on a continued drop in crude oil. Meanwhile, still seeing the bid coming into some of those, I guess, inflation hedges, if you will. Gold at a record high. Silver getting a strong bid as well, $32 an ounce.
I think I counted like 3 record highs in your market wrap just there.
Yeah, there you go.
A lot of highs there. All right, let's take a look at some individual movers. Wells Fargo up by the most in 7 months. Bloomberg learning that the bank has sent the Fed a third-party review of its risk and control overhauls. This is the latest step in Wells's, 7-year journey to get out from under this Fed cap on its assets, which of course limits its growth. Micron still riding high after yesterday giving it an unexpectedly strong outlook thanks to demand for AI gear, gaining the most in 13 years. And another company that has benefited from the boom in AI spending is Supermicro, but today down 12%. The Journal reporting that the DOJ is now investigating this company following a critical report by Hindenburg Research, the short seller. Now, our top story this hour is the wave of muni bond refinancing. It turns out that homeowners are not the only ones seizing on the Fed's rate cut to reduce borrowing costs. State and local governments are also on a refi kick. So far this year, muni bonds sold only to refund existing debt have topped $66 billion, making up almost 1/5 of all state and local government debt sales. That's the bottom line there. And that is the most since 2021, when rates were still at rock bottom. Chicago, by the way, one of the cities proposing a refunding sale in order to save on debt service costs. Later on in the program, we'll be speaking with the Illinois State Treasurer, as well as the head of PGIM's Muni Bond team.
All right, absolutely looking forward to that conversation. But before we get there, we have to talk a little bit about broader macro conditions. Tomorrow, investors need to brace themselves for a key data point. The Fed's preferred measure of inflation is due tomorrow. That personal income, personal spending, and PCE core deflator. Lindsey Piegza joining us right now, chief economist over at Stifel. She's writing that stagnant inflation has shown a lack of real improvement since June. The Fed must remain focused on inflation as their job is not done. Pleased to say that she joins us right now. And just taking a look at the Bloomberg terminal here, we are expecting some moderation, at least based on the economist survey we had, in that core PCE number. I am curious as to what your expectations are and whether we should read too much into it.
Well, I do think the inflation numbers are always a key metric of the economy, but they're going to play an even more important role in determining the Fed's willingness and ability to adjust rates going forward in November and December. Now, the PCE, the headline, we do expect to see some further improvement, some further encouraging data, maybe a 1/10 or 2/10 of a percentage point decline, which would take us from 2.5 to potentially a low of 2.3. But on the core, after several months of moving sideways, positing no further disinflationary momentum. This is where my primary concern comes in. We could see an uptick, an actual reversal of course, going from 2.6 to 2.7. Now, it's not a meaningful rise. It's not a sizable increase on a monthly basis.
Yeah.
But again, this does underscore the fact that the Fed's battle with price stability is not yet done.
What do you think is sort of, I guess, holding things up, if you will, Lindsey? Like, why aren't we seeing a more meaningful move to the downside in that key core PCE number? Is there something specific?
Well, certainly housing services, housing shelter costs are playing a sizable role. And we see that playing out in the CPI as well. Looking at the core CPI, we've also seen this sideways movement. But what we continue to see also is this broad-based stickiness in terms of services costs. And that's what the Fed is really struggling with. While we may be importing some disinflationary pressures on the goods side, it really is the services component that is remaining elevated and complicating the Fed's ability to get us back to that 2% level, and not just touch 2%. But remember, the goal is to reach 2% and maintain that level on a sustained basis.
I'm just going to jump in here because we do have some earnings from Costco. Costco reporting that fourth quarter comparable sales in the U.S., excluding gas and FX, rose 6.3%. The consensus estimate was for an increase of just under 6%. Fourth quarter total company comp sales, including gas and FX, rose 5.4%, also better than anticipated, which was an expected 4.25%. The stock moving up about 1% in after-hours trading remained, but it doesn't tend to move a whole lot because it does report these monthly sales numbers.
Yeah, we get those monthly numbers. So we kind of know kind of where
Exactly.
this is going. It does kind of make you wonder, though, whether there is a broader read here on the economy, given how some people use Costco as obviously a way to save money. And I am told that you're like a gold member?
No, titanium.
Titanium.
We upgraded, yes.
Okay, all right.
Diamond member, yes. By the way, fourth quarter EPS $5.29, beating the consensus estimate, but total revenue of $79.70 billion does trail the average analyst estimate of $79.96 billion. So, Lindsey, let me come back to you, and maybe we can connect the dots here between what Costco told us and what we're seeing in the economy overall, especially when it comes to consumer spending. A lot of people still describing where we're at as the late stage of the economic cycle. Has the recession risk largely disappeared at this point?
I think the risk of recession is still non-zero, certainly, but I think the risk remains very minimal. Looking over the next 12 to 24 months, we have it at about 25%. So it is a real risk, particularly as we do see some signs of cooling, some signs of normalization in the data. But right now, when we look at the latest read, now, of course, this is in hindsight, but the latest GDP read showing the economy accelerating at a 3% pace, with the consumer still out in the marketplace buying goods and services, businesses still investing. This is a pretty solid indication that domestic activity is on strong footing, solid footing, and in a good position to withstand a very slow and patient removal of policy firming as the Fed hopefully takes a very patient approach to additional rate cuts.
Is it too early, Lindsey, to start our hand-wringing over the next big data point after PCE, which would be the jobs report on Friday? I know there's some stuff leading up to that, including ISM services and ISM manufacturing, but jobs will be the key point here because after inflation, the Fed's super concerned about the labor market. And when it comes to the employment picture, the issue is that as long as people have jobs, they're going to be comfortable spending. And we are still growing jobs in this economy, 140,000 expected for the month of September. At what point do we start really wringing our hands over those numbers?
Well, that's what's so interesting. While the Fed did make a decision to make that more aggressive move of 50 basis points out of the gate, the Fed still maintains a pretty solid assessment of the labor market. Now, acknowledging that momentum has slowed, certainly job creation, job conditions still remain very near a tight-ish labor market. As you mentioned, we're still creating on average about 188,000 jobs since the start of the year. The unemployment rate is still at a very low nominal level and well below what the Fed tells us is the full employment range, or what they see as the sustainable range for joblessness. And on the other side of the equation, jobless claims have not ticked higher. We have not seen a sizable increase in layoffs either. So both sides of the labor market equation seem to be relatively solid at this point. So if we should see a reversal in inflation coupled with the next round solid non-farm payrolls report, that's going to create quite the conundrum for the Fed that does appear desperate to continue along this policy pivot pathway.
Well, that's what I'm curious. Did that 50 basis point cut, and more importantly, the promise of 50 more before we even get to the end of the year, and God knows how much next year, has that sort of put them in the corner?
Well, remember, the Fed was very clear they're not on a predetermined path. And the dot plot should not be taken as a commitment to policy adjustments, but simply the assessment of the median among committee members. But it's always been a data-dependent position. So if we see a reversal in inflation, if we see stronger than expected labor market conditions, the Fed, I think, would be very willing to certainly consider additional rate cuts at every meeting going forward. But there is no commitment to a rate cut at every subsequent meeting.
All right, Lindsey, really appreciate it. Lindsey Piegza is chief economist over at Stifel. Coming up, we're keeping an eye on Costco. Those shares are now down in after-hours trading after its latest results, losing 1.25%. This is Bloomberg. Shares of Costco dropping following its latest results, in which EPS beat analyst estimates, but total revenue does come in a little bit lighter than what analysts had anticipated. Karen Short is head of consumer and retail at Melius Research, and she joins us now. Karen has a hold rating on Costco. So, Karen, what do you think is happening here with the company reporting better than expected earnings per share, but the revenue not meeting the consensus estimate?
Well, I think the basic thing is it's very over-owned, because when you look at what I call the essential retail space, there's not a lot. There are very few names to actually own. So expectations were high on Costco. I do think that obviously everyone knew what sales were. So it's a function of gross margin more than anything. But I think what we have to see is when they have the call, they talk about core gross margin more than anything. And that's what's the most relevant component. So it's not about, gross margin reported. It's about core ex gas, core on core. So we'll see what they say, but they never provide that on a press release.
Well, Karen, I am curious here just kind of about the broader health of the consumer. There's been a lot of discussion here that certain folks are pulling back, certainly at the lower end, even in the middle income spectrum. And we've even had some anecdotal evidence of people at the higher end of the spectrum. Does that benefit, though, a company like Costco?
I think on the discretionary side, it's going to be a challenging fourth quarter. And that's not, that's not specific to Costco. Yeah. But, they just keep gaining share. So if you look at, obviously, you look at their comps relative to Kroger, Albertsons. Yeah. You name it.
Yeah.
They're clearly gaining share, and it's not a function of whether or not you have, you're paying for MFI, which is obviously their membership fee, not related, because their prices are so appealing.
Karen, you mentioned membership fee. We know that Costco is cracking down on password sharing, or in this case, membership sharing. To what extent can you model out a similar rate of new memberships now that Costco is making everyone scan their membership in the same way that Netflix saw a pickup in signups?
So when we initiated, we actually had that in our report, and we did a whole sum of the parts on MFI, with a % growth rate, and then actual four-wall, growth rate. So, it could get you to the $1,200 range on Costco's valuation. It definitely, but it's very sensitive to what you think the sustainable growth rate on MFI is.
All right. Well, it's something to keep an eye on here. And of course, a lot of people kind of interested here. And I think where the sort of broader economic conditions go and whether those people who, I guess, rely on Costco continue to rely on those that don't, maybe start gravitating to it. Karen Short, head of consumer and retail over at Melius Research here. Costco shares down about 0.8%. I know you go here a lot. I mean, do you go there for the cost savings, or are you just going there because, I don't know, you just like to roam around a warehouse?
Both.
Yeah.
Yeah, I do it for all of that and for like who knows what you'll find.
Who knows what you'll find?
Yeah, because they have lots of things there that you're like, oh, I didn't know that Costco carried this. And if you don't buy it right then and there, they might not have it anymore. So it's like TJ Maxx in a way, on a grander scale.
Yeah, I don't go there either. That's just, yeah. Well,
you and I should never go shopping together.
No, I would not last. I'll just wait in the parking lot in the car for you. All right. We got a lot more coming up here on the big program. Scarlett, you were talking about municipal bonds. That was your top story of the day. And we are going to take a closer look at that and start with a look back at this day in history, the day when the municipal bond market went from a safe haven to the lion's den as the burgeoning global financial crisis took an unexpected turn. That conversation coming up after the break. This is The Close on Bloomberg. All right, let's look back to this day in history, 2008, where I'm going to tell you how the municipal bond market got flipped, turned upside down. As bond insurers teetered, retail bond buyers balked, and the backstop of bank dealers threw in the towel. With no good in the neighborhood, it was on this day when we saw municipal yields from New York to Chicago to Hawaii surge to record highs. A $2.7 trillion market where defaults historically are few and far in between found itself reeling from a series of jolts that largely started back in February of that year when investors abandoned the auction rate market. Now, that auction rate system was crucial. It allowed municipalities to sell long-term debt at cheaper short-term rates that reset every 7, 28, or 35 days through bidding arranged by Wall Street banks. But a decline in the creditworthiness of the bond insurers like AMBAC, like MBIA, it rattled investors. All but 2 of the 7 top-rated firms that insured the tax-exempt market lost their AAA status as their other business of backing subprime mortgage debt was spiraling down in value. As a result, demand from institutional muni bond buyers evaporated. Insurance companies, they reduced their holdings, and mutual funds suffered weeks of outflows. And arbitrage funds, they just locked their doors altogether. Municipalities, hospitals, universities suddenly found themselves unable to raise money at all. By September 26, yields on long-term municipal bonds reached their widest compared with treasuries. Interest costs on new debt, as measured by the Bloomberg Short-Term Muni Bond Index, that climbed 5-fold in 2 weeks to a record of 8% or more. And the interest rates on muni bonds outstanding, they were resetting at predetermined maximums, some as high as 20%. All told, the turmoil, it left at least 41 states and the District of Columbia with shortfalls that would take years to recover from. Municipal bond investors, they were decimated, losing about 8% in 2008 when you include reinvested interest. That's according to Merrill Lynch's Municipal Master Index. And a separate Bloomberg index for high-yield munis, that plunged a record 27% that year alone. Those were the worst annual performances for muni debt on record then, and still remain the worst performances on record now.
All right, let's stick with the muni theme here because Illinois, which has one of the lowest credit ratings among U.S. states, has been clawing its way back into the good graces of investors. It has earned at least 9 credit rating upgrades in the last 3 years, pulling back from the brink of junk near the start of the pandemic. A lot of that progress is owed to the treasurer, Michael Frerichs, the state's chief investment and banking officer. I'm pleased to say that Michael now joins us in studio. Welcome to Bloomberg.
Happy to be here. I can't take all of that credit. We had a new governor. We had a General Assembly that were committed to passing balanced budgets. And it's amazing how much good balanced budgets year after year can do for a state.
Okay, so let's go on that because clearly there are lots of steps required in kind of bringing Illinois back from the brink. What do you think was the single most important thing that Illinois did to restore its standing?
Yeah, I think we had a previous governor who was intent on pushing a personal agenda. He held the state hostage. We went 2 years without a budget. Had a backlog of unpaid bills up to $16.5 billion. Really had a 9 credit downgrades or so. Since our new governor, J.B. Pritzker, has come in, he's been committed to balancing budgets, paying extra payments into the pension system, and we've been rewarded with, I think, now 9 credit upgrades, and that backlog of bills has been paid down.
You've been rewarded with those credit upgrades. You haven't necessarily been rewarded with regards to the premium that you still have to pay to investors, which is kind of curious. I mean, you're still at a 63 basis point spread over AAAs right now, which is actually worse than some of the states, including one next door to us here in New York, that actually have a lower credit rating than you. What's going on?
I don't know. I think there's some effort to set an example with Illinois, but we're going in the right direction. I tell people we didn't get into this problem overnight.
Right.
We're not going to get out of it overnight.
Right.
And it's just like any relationship. It takes a while to rebuild trust.
But a lot of that broken trust, that was, quite frankly, almost decades in the making. And obviously, I know a lot of this predates you here. But there were pension obligations, there were fiscal decisions that were, in hindsight, completely ill-advised here. How do you sort of repair that trust in a way that you're not going to get a repeat of that when, say, a new administration comes in for Pritzker or for some of the local municipalities?
It takes years of commitment to fiscal responsibility to rebuild that trust. You know, when I came into office, we're in charge of college savings programs. We had one of the worst rated programs in the country. I had people all the time say, I don't trust the state of Illinois to manage my kids' college savings fund. We came in, we cut fees in half, we changed the investment lineup, we made big changes. We got rewarded with ratings upgrades from Morningstar, and then after a few years, we saw that trust returning. Now, we've now grown from about 350,000 accounts to over 900,000 accounts. We've grown from about $7 billion in assets under management to over $20 billion. But it doesn't happen overnight.
You talk about this fiscal responsibility that Illinois and the states have to do in order to balance their budgets. What can federal officials, what can Congress learn from treasurers and state officials about how to balance politics and spending decisions, because it's not happening?
I think they can learn from Illinois over the last 6 years what to do, and from Illinois the previous 4 years what not to do. Unfortunately, Congress has chosen to act like our previous governor and to hold responsible budgeting hostage to their own personal agendas. You know, businesses, states, they crave continuity, they crave certainty, they like to make long-term plans, and when Congress continues to kick the can down the road, month after month, this latest 3-month extension doesn't provide the certainty and the security we need.
You talk about what Congress has been able to do. One thing they did do in the last couple of years was pass the Inflation Reduction Act. And I'm curious to hear from you what impact that's had on Illinois' pension funds.
Yeah, so I am a trustee on one of our pension funds, but with our state funds, we also invest in things like venture capital and infrastructure. I have 2 funds, up to 5% of our portfolio to invest there, and we've found a lot of opportunities come about because of the IRA.
Specifically?
Specifically in the energy transition. There are credits out there. There's been a wealth of capital flowing into here. I think by one account, over $220 billion into clean energy. And we see opportunities in the state of Illinois, whether it be with a company like Renewance working on battery issues, or energy transitions like a company like Nexamp that we've invested in. And we're getting good returns. We're helping create jobs in the state and helping, I think, with our environment as well.
I am curious on the infrastructure side, too. I mean, there's been a lot of talk about certain improvements that need to be made. I know earlier this year, the city of Chicago voted on some debt proposals to revamp O'Hare Airport and a few other things here. When you see those types of projects here, do you think that is, I guess, good fiscal policy given the added debt load, given how much they've worked to actually reduce that debt load? I
think it depends if you secure that with new source of revenue, if you can back that up and give the market guarantees you're going to pay that. Investing in infrastructure, I think, pays off good dividends. But you have to be smart about how you do it, smart about the projects you invest in.
But do you have a sense, though, because the idea is we know the investment needs to be made. What's the return? Are you raising fees, or do you end up one of these cockamamie ideas where they're selling off our parking spaces to, whatever, Eaton Vance, Merrill Lynch, whatever it was?
Have you been to Chicago and paid for parking on the street?
Yes.
You're familiar with that deal?
Yes, I am.
It's not good.
And it's probably more expensive than parking in a lot some days.
Some days it is. So that was a bad deal.
Yes.
We're not engaging in those kind of things of selling off assets to pay off operating costs or something. So what we have is we got permission from the General Assembly to invest up to 5% of our state portfolio in Illinois-based infrastructure projects. And we think that we're making good investments. We're already seeing good returns. And that's the way to do it, rather than to take on additional debt for these projects.
All right, Michael, you're talking to a Chicago boy. I'm old enough. I grew up there where you can park on the street, for a nickel or whatever it was back in my day. And now, God forbid. Great to have you here, though.
It's great to be
and obviously doing some great work. Illinois State Treasurer Michael Frerichs there here as part of our Muni moment as we stick on this topic, the Muni market, and more importantly, that spending on infrastructure. An influx of travelers has fueled a borrowing boom. And U.S. airports have sold more than $12 billion of debt this year. It's an effort to raise cash for expansion projects. Here to talk a little bit more about this is Jason Appleton. He's head of municipal bonds over at PGIM Fixed Income. Jason, great to have you here. And I do want to talk about the modernization of these airports. We've seen this here in New York with some great improvements they've done to LaGuardia, to JFK, O'Hare earlier this year. The city council there approved some new debt to try to sort of fix that up as well. Is this good money being spent?
Absolutely, and it's necessary money being spent. I mean, you look pre-COVID, when COVID actually hit, the airports didn't have a good sense of what the future of traveling by air would look like. I have a neighbor who builds the lounges for for Capital One, and he told me, like, when he was flying around during the pandemic, he was the only one on the flight. But now that you realize that TSA activity has exceeded pre-COVID levels, the expansion is necessary.
We'll get to lounges in a second because I got a beef with that. But I do want to talk about from an investor perspective and investing in specifically airport types of projects here. Do they typically offer pretty healthy returns? Because, I mean, you're putting a lot of money into it, but where is the money coming back? Are they raising fees? What are they doing?
Absolutely. So airport debt is paid with leases from the airlines, and there are different configurations on how the airlines pay those. But essentially, it is a good investment for the airline because they're refurbishing gates, adding capacity, and overall, it's a win-win for both the airport and the airlines.
So Sacramento, Charleston and South Carolina are all municipalities that are selling or planning to issue debt for their airports. Which projects are getting the most attention right now?
I think they're all getting a lot of attention. I mean, these are big deals in the muni market. We all know supply has been elevated in the muni market this year. But I think especially airports, which are often subject to alternative minimum tax or AMT, are getting a second look from investors because the premium that the issuers offer for those AMT bonds can range somewhere in the tune of 80 basis points. Got it.
And we've seen a 100% increase in airport debt issuance, which is simply massive. But we know that these things go in cycles, right? Because, you spend a lot and you work on the project and then you don't have to borrow for a while. So does that mean we're in a quiet multi-year period coming up for these kinds of airport debt?
I wouldn't call it quiet. I think most of the capital improvement programs last 3 to 5 years. So I think we would see this level of issuance continue for that period of time, especially as airports who paused their capital programs during COVID catch up.
I am curious, too, about the political environment we're in right now. We have an election coming up. There's a potential, depending on how it shakes out, we could have some significant changes in tax policy. And I'm wondering how that feeds into the municipal market. Does that potentially make munis more attractive, or is this going to make, or the opposite?
We think so. I mean, there's a number of permutations of outcomes of who's in Congress, who's in the White House. But I think there's a lot of anxiety that taxes could reset higher, especially with the Tax Cuts and Jobs Act legislation rolling off in 2025. So everything's on the table. You've got personal income tax rates. AMT is something we already talked about, corporate income tax rates, and frankly, the exemption itself could be at play if it's used as a pay-for to fund some other issues from the candidates.
All right, good stuff. Jason Appleton is head of municipal bonds at PGIM Fixed Income. Thank you so much.
Thank you.
All right, we do need to get to some breaking news. This involving New York Mayor Eric Adams. Of course, we learned earlier today here that his Gracie Mansion, the home he has here in New York, had been raided. We're now learning that Eric Adams will be arraigned Friday in a Manhattan court tomorrow. Of course, earlier today, we learned about the indictment by federal prosecutors looking into allegations of bribery and other malfeasance by him and his administration. We're now learning that he will be arraigned Friday in a Manhattan court. We're going to try to get you some more details on this, and we'll get back to this story after the break. Scarlett.
Yeah, and this was news that kind of mesmerized most of us here in New York all day. Having said that, you look at what happened in the markets. Just by the headline numbers, it seemed like a quiet day, but we did finish up by 0.4%. This is the 42nd record close this year, right, for the S&P 500?
Who's counting, Scarlett Fu? I mean,
I'm counting. You also have FXI, the ETF that tracks Chinese shares, gaining 8%, almost 9% at this point, given that China is now considering even more fiscal stimulus on the heels of monetary stimulus and this whole package of stimulus measures it announced this week. The dollar weaker by 0.4%, and not much movement in treasuries, 3.79% for their 10-year yield. This is Bloomberg.
New York City Mayor Eric Adams indicted today on bribery and fraud charges. Adams, who says he will continue to serve as mayor and says he has done nothing wrong, will be arraigned on Friday in Manhattan.
It's an unfortunate day, and it's a painful day, and I look forward to defending myself and defending the people of this city.
And that was Mayor Eric Adams speaking a little bit earlier today. Joining us right now is Laura Nahimas, Bloomberg's senior reporter covering New York City and state politics. And Laura, let's talk about what could potentially happen tomorrow. We heard from federal prosecutors today laying out the case for what they say was this malfeasance by Adams and his administration. When we see this arraignment tomorrow, are we going to hear more either from the prosecution or from Adams himself inside that courtroom?
I think it's definitely possible. It's a stark visual symbol of what's happening to the mayor, a potentially humiliating thing for a person who is the mayor and was elected to run the United States' largest city, to be arraigned in federal court and accused in a formal way of all of these alleged charges. He's insisted that he's done nothing wrong, but we've also seen him make multiple statements over the last 24 hours defending himself, insisting that he's innocent. His defense attorney has also put out several statements and is proactively sharing information that they say shows his innocence and his good intentions. And I think that we might expect to see the mayor say even more to defend himself in the days to come.
And he's made clear that he is not going to step down. Having said that, can anything or anyone force his removal?
Right. So this has forced all of the reporters at City Hall to become really acquainted with some obscure sections of the New York City Charter. There are apparently two paths that exist to removing the mayor from office against his will. One of them is that the governor, Kathy Hochul, could remove him. She has so far declined to say whether or not she would take that step. The second is a sort of vaguely outlined clause of the New York City Charter, something called an inability committee that's composed of several senior city officials who could make the determination by a majority vote to remove him, and then potentially convene a panel made up of the city council members who could, by a majority vote, decide to remove him from office.
There is a more practical matter here. I mean, first of all, you already had an election coming up next year. And of course, with this being a primarily Democratic city, a lot of this is decided primarily during those primaries. On top of that, you're going to have a mayor, assuming that this case goes forward, that is going to have to spend a lot of time defending himself in court. So whether he wants to stay or not, is he actually going to be able to do his job?
That is the question that most of his critics right now are raising. Even the ones who've stopped short of calling for him to resign are raising serious questions about his ability to manage the city at this moment. A reminder, he came into office at a moment of crisis for the city in early January 2022. The city was still reeling from the effects of the pandemic, which was very much going on and had killed thousands of New Yorkers and cost thousands of jobs. There were lots of vacancies in city government, and he's been tasked with recovering from that. add to that he's had to deal with the arrival of more than 200,000 migrants, many of them intending to claim asylum.
Well, but Laura, this gets to the issue, though. I mean, now he's dealing with more vacancies because a lot of people have jumped ship because of this investigation here. So who's running the city? If you are a New York City resident, who am I looking to know who's running our schools, who's running our police department, and quite frankly, who's running City Hall?
Well, I think Mayor Adams is trying to project that he is still very much in charge, but that is a very good question, and one I think a lot of people are seeking the answer to. There are a significant number of vacancies in Adams's administration, including people who have abruptly resigned in the last month and others who have announced their intention to leave the administration by the end of this year, creating sort of instability at City Hall. And people are really questioning how well the city is being run at this moment. And as these investigations progress and the mayor's fighting for his political future and his future in general, whether or not he'll be able to give the city the attention that it deserves.
So we know Alexandra Ocasio-Cortez, AOC, has urged him to step down, and a number of other elected officials, primarily those who are running against him next year in the mayoral campaign, have done the same. Has anyone come out in support of him?
There have been a couple of people, some interesting names. Bill Ackman has posted a tweet, I guess you would say, or a post on the social media platform X, calling for people to let the process play out, calling for due process. The head of the Partnership for New York City, a coalition of businesses, Kathy Wild, has also called for people to give the mayor the benefit of the doubt, essentially, and let due process take its course. And he held a press conference today outside of his home at Gracie Mansion, flanked by some people who are supporting him. But even at that event, he was shouted down by hecklers who were calling on him to resign. So he's got some friends still, and he's got some defenders, but there is a growing chorus of people who are questioning his ability to lead in the wake of this indictment.
Yeah, interesting. I didn't know about the Bill Ackman thing. That seems kind of rich. But I mean, we've already heard from AOC basically calling for him to resign. And I think, some of the potential candidates to replace him, of course, have also said that he needs to step down as well. Is that correct?
Yes. 3 of the 4 people who are most seriously considering challenging him in the June 2025 primary have come out with statements calling on him to step down and questioning his ability to lead.
All right, Laura Nahimas, Bloomberg senior reporter covering New York City and state politics, certainly keeping us up to date on what's going on with Eric Adams, the mayor of New York City, who was indicted today and is expected to be arraigned tomorrow in Manhattan court. When we come back, we're going to set you up for tomorrow's trading day. There's some Chinese data. There's also some U.S. data, one of which the Fed kind of pays attention to. This is The Close on Bloomberg.
Coming off a record day on Wall Street, here's what could move the market over the next 24 hours when we start overseas. 9:30 p.m. tonight, we get data out of China.
Yeah, these are industrial profits, and it matters because, of course, China has called for more fiscal spending. They've also unveiled these measures to stabilize the property sector, and they cut rates. So we'll see if the backdrop here for all these stimulus measures.
Then we go over to Europe at about 4 a.m. in New York time. We're going to get CPI data out of the ECB. But let's come back here to the U.S. because a key inflation report at 8:30 a.m. Eastern.
Yes, PCE and core PCE specifically is what the Fed looks at, and that's what we're going to get. And as Lindsey Piegza was telling us earlier, on a year-over-year basis, we could actually see it tick higher.
Yeah, and I think it's interesting. She's saying that the Fed maybe needs to refocus on inflation and a little bit less on the job market. We are also going to get some additional Fed speak, including from Mickey Bowman at about 1:15 p.m. Eastern time. We'll have all your market coverage right here on The Close. But stick around. All your politics coverage coming up next on Balance of Power right here on Bloomberg.